If you're investing in the ASX, chances are you've probably heard of or are already using exchange-traded funds or ETFs, and for good reason. They're low cost, they're efficient, and they're easy to understand. But in the rush to keep fees low, many investors might be overlooking listed investment companies or LICs, which could be a missed opportunity. That's why in this video, I'm encouraging you to keep an open mind. ETFs and LICs each have unique advantages, and knowing how they can work together can help you build a stronger and more resilient portfolio, whether you're focused on income or growth. My name is Vishal Teckchandani. I'm a senior editor at Livewire Markets, and as someone who's covered the stock market for over 15 years, I'll break down ETFs and LICs step by step, and I'll also walk you through a real market crisis to show you how each investment responded under pressure. By the end of this video, you'll have a great idea of the use cases for each of these investment products. Now, at a high level, ETFs and LICs are what the finance world calls investment wrappers. Think of them like the tortilla wrapping around a burrito, holding all that good stuff inside. But just like with food, what really matters is the filling, or your actual investments. These wrappers can hold Australian stocks, global shares, bonds, or even commodities like gold. What you put inside and how much of each is what ultimately drives long-term returns. But while the filling does matter, the wrapper you choose also plays a key role. So what's the difference? Let's start with ETFs and their key features. ETFs are open-ended, or in plain English, ETFs can grow as big as there is demand from investors. Unlike some investments with a fixed number of shares, ETFs can create more units when more people buy in. ETFs are mostly passive. They track an index like the ASX 200, S&P 500, or the NASDAQ. And because of that, they have relatively low fees. Again, they're following the market, they're not trying to beat it. And they trade close to their net asset value, or NAV. The NAV is the true price of an ETF, calculated as its assets minus liabilities divided by the number of units available. So if an ETF's NAV is $10, it should be trading at $10 in your broking account, not at $9.50 or $10.50. And this matters a lot to investors who want to buy and sell their investments at a fair price, not at a premium or a discount. ETFs have a special mechanism to help with this called authorized participants. Think of them as the air traffic controllers of ETF pricing. If an ETF's price drifts too far from its NAV, APs step in to create or redeem ETF units, adjusting supply and demand. This helps keep the price aligned with its actual value so that you're not overpaying or underpaying. That's ETFs for you in a nutshell. Now let's compare them to listed investment companies. So here are the key features that distinguish LICs. Just like stocks, LICs are companies. They have their own management teams, board of directors, and balance sheets. And they pay taxes on the profits which they earn, which allows them to generate franking credits. The interesting thing about this is that you could invest in a global equity LIC and potentially get franked dividends, something that's not possible in a global equity ETF. They're closed-ended. The number of shares in an LIC is fixed, so new investors must buy from existing investors, not the fund itself. LICs are actively managed. Fund managers are making investment decisions with the goal of beating the stock market. And because of that, LICs generally have higher fees. Because again, you're paying for active management and all that research expertise. And now I want to get to two of the real unique features. The first is LICs have the ability to hold what we call profit reserves. So profit reserves are basically profits that an LIC can keep aside for a rainy day to help pay consistent dividends. This is very different from ETFs and traditional managed funds, which have to pass all of their income that they collect over a year back to investors. The second is LICs can trade at a discount or premium to their true price. Unlike ETFs, which have those authorized participants to keep prices aligned to their NAV, like I mentioned earlier, LIC prices are driven by supply, demand, market sentiment, and also performance. So while an ETF at a $10 NAV will trade at $10, an LIC will often trade at a 20% discount or a 20% premium to their preferred gauge, which we call net tangible assets or NTA. Now, why does this matter? Because discounts give investors a chance to buy assets below their true value. If the discount closes and the market rises, you potentially get a double boost, the price returning to the NTA plus those market gains. But the flip side is that discounts can keep getting worse, meaning that even if the underlying investments of an LIC perform well, that won't necessarily showcase in your returns. Again, it all comes down to supply, demand, investor sentiment, and performance. Now let's turn to a real-world case study that highlights how ETFs and LICs perform under different market conditions. Remember the market crash of 2020 after the COVID-19 outbreak? Not only did stock prices take a dive, but so did dividends. In that year, ETFs tracking the ASX 200 like A200, STW, and IOZ saw their distributions shrink as key dividend-paying stocks, particularly the banks, reduced their payouts. The market's yield fell from 5% to 3%, and those ETFs mirrored that decline, as they simply passed on the reduced income to investors. On the other hand, an LIC like WAM Leaders, which aims to beat the ASX 200, went the other way. It tapped into its profit reserves to boost its dividend by 15%. So whereas your typical ETF was paying around less than 3%, WLE offered a fully franked yield of 6%, which equates to nearly 9% when we take franking credits into account. And if you look at the 2021 financial year, WLE's portfolio grew 37%, while the ASX 200 added 27.8%. So outperformance plus a growing dividend in a time of crisis likely gave WLE a good sentiment boost. Now, in theory, purely as a general observation, holding both an ASX 200 ETF and an LIC like WLE could have provided a more resilient income stream during that period. But it's important to note that that is just a selective example and this is not advice. I'm just looking at the performance of investments in the past. I should also highlight that income is just one part of the equation. Some LICs, despite paying very attractive dividends, consistently trade at a discount to NTA. And while LICs aim to outperform passive ETFs, not all fund managers deliver on that promise. So before you chase dividends alone, it's crucial to weigh up all those factors, including performance and fees and valuations, because a great yield doesn't always mean a great total return. Now, to summarize, ETFs and LICs don't have to be an either-or choice. They can complement each other in a portfolio. ETFs provide broad, low-cost market exposure, which could form the ideal portfolio core, while ETFs track close to their NAV, so you don't have to worry about discounts or premiums affecting your returns. You simply get what the market does. LICs offer active management and the potential to outperform the market. LICs can trade at a discount, which means if the gap closes and the market rises, you get that double boost like I mentioned, but there is no guarantee that this will happen. LICs can pay more consistent dividends by banking profit reserves, while ETF distributions fluctuate based on market conditions. But remember, it all comes down to your goals and objectives and preferences, as well as careful research on the different products and how they fit together. That's it from me for today. I really hope you enjoyed this video and got a better idea of how ETFs and LICs can work together and how they can fit together in your portfolio. If you found this helpful, please hit that like button and subscribe to our channel so we can keep making more educational content like this.